Hey dreamers, I thought today I would review another batch of options that I've done recently. And the reason why this one is super interesting is because I did a ton of option experiments. And so I thought it might be interesting for you to see what mistakes I made. And in particular, I broke two cardinal rules that I went over in the other options video. One of which is not to make any moves during earnings or dividend weeks, because you have less control and less foresight into how the market is going to react to any kind of news. And even though you might have really good research and know your stuff, you really cannot ever know how the market is going to react to something. And that adds a ton of volatility to your trades. So what experiments did I run and how did it turn out? Let me show you. First of all, you can see this was all that first week of May. And what I've done is highlight in green all of the ones that I did not mind if they executed. And that was my first mental exercise. And I think a valuable one as you go through setting up what covered calls you want to sell and what puts you want to sell. And I also organized this from the most that I got down to the least that I got. And over in this column, you can see how many lots were involved. And of course, the definition of a lot is 100 shares. And oh, by the way, before we go any farther, how did I get this spreadsheet at all? I simply went into Fidelity, went into Activity and Orders, hit the filter button, selected Options Only, and then hit Download, which is right next to the print button, and then added a little bit of color so that you could see this a little bit better. So let's go through it. The first one I did was I created a put on Qualcomm at $114. Now, this one I didn't mind executing because as I started doing my research, you could see that Qualcomm over the last 18 months used to be up closer to $200 a share and has slowly gone down almost to $100 a share. And so if you know anything about chip makers, you know that their business is highly cyclical and that this part of the cycle is going to be closer to their low end. And so my theory was I'm okay if this executes somewhere down here because there's two reasons. I can hold it for the next couple of years and hopefully gain from appreciation. And in the meantime, I can continue to wheel it back and forth like we've talked about with calls and puts and make a little bit of money on something that's a little more volatile since my portfolio is pretty steady. So that was my thought on Qualcomm. And the rule that I broke on Qualcomm was that this was the week they were going to announce earnings. And if you remember, I mentioned that if you're looking for smooth sailing in doing options, that you try to avoid earnings and dividend weeks. And so that's one experiment I wanted to test out. In addition to setting a strike price that was a little more risky for me. And I think it was somewhere in the neighborhood of 0.25 or 0.3. So I knew that for that $200 I was getting, I was taking on quite a bit of risk. So that was Qualcomm. Now, these next ones are TQQQ puts. And again, everything in green was something that I mentally said to myself, I was okay if it went ahead and executed at the end of the week and assigned. And the reason why I'm okay with that for TQQQ is that I just continue to wheel these back and forth, buying and selling, and got about $450 for those. The next one that I was okay with executing was MetLife. MetLife is a company and stock that I've owned for a while and I know pretty well. It's a quality company with a very low payout ratio. And as I started looking into it, you can see how high that stock price has gotten. And that it recently went through quite a bit of a dip from around $70 all the way down to $50 and then started climbing again. So I was okay with putting one lot on the line, and I know that I can buy and sell Met pretty much every single week at a fairly good price. So this is one I don't mind if it executes because I can wheel this one back and forth or just hold for the long term. And so I set a strike price at 61. And this was another one where I broke the rules because Met had an earnings week this week, and so I knew it could be quite volatile. And then we go into the next section here where these are puts and calls that I did not want to execute. And so I used all of the rules that I had set up before, where you can sell puts and calls during weeks when there's no earnings and no dividends, where For me, I take the easy road and I focus on deltas that are usually zero point 0.1 or less, sometimes as high as 0.15, but usually never higher than that. I just keep it extremely conservative. So I did that on Google, on Pfizer, on Shopify, Philip Morris, and on 15 lots of tea. Now, Shopify was one I was very much struggling with, and I thought about making that one green in terms of my mentality around it. Because take a look at this graph. I mean, Shopify was almost at 175, and of course, it's been all the way down to in the 30s around the middle of last year. But Shopify is one that I've always thought is a great business that is bound to rebound at some point. And I even had this conversation recently with someone on Twitter, Hot Girl Finance, just around the opportunity with Shop. But alas, I didn't do that, and I decided to set this up at a strike price of $41.50 and made about $30 on it, thinking that it would not execute. And so you can see the rest here. I was okay buying more STWD, and I was okay if these executed too. One lot of Mo, 2 lots of T, 1 lot of Sun, and buying 1 lot of BMY. Bristol Myers Squibb is another one that I really didn't mind executing, and I see as a little bit of a value right now, dropping from a share price of $81 in December of last year down into the 60s now. So I went ahead and set up a strike price of $66, followed by a few others here that didn't make me very much, but it's because I didn't take on very much risk, because I didn't want them to execute. So a couple in IBM, SoFi, and AbbVie. So how did this experiment turn out? Which ones of these actually executed? And did I make any money off of this week? Now, this was a week I specifically wanted to experiment, and so I didn't anticipate really making anything this week, knowing that I knew there were going to be mistakes. And as you know, I always end my videos with saying, put your learnings into practice, because that's when it really sinks in. So technically, I made $1,071.61 from selling all of these puts and calls. So here are the results. At the end of the day, there were only 2 that actually executed. 1 lot of Qualcomm at $114 and 1 lot of MetLife at $61. And the rest of all of those calls and puts expired worthless. In other words, I just collected the premium that I made on each of those trades, but I didn't actually sell or buy any of these trades, except for the ones in green, MetLife and Qualcomm. So let's zoom out for just a second. The rules I broke were that both were on earnings weeks. And so although I had some inkling as to what could happen, I really had no idea how the market was going to react to it. And so for MetLife, it started the week around $62, $63, something like that, and my strike price was $61. But it ended the week at $54.66, which technically means that for each share, I overpaid by about $6.34. So if you multiply that by 100 shares, technically on paper, that means I lost $634 because I paid $61 for a stock that ended the week at $54.66. In other words, I could have bought it for $54.66, but I overpaid by $6.34. Now I made $89.31 on that trade. So technically, and again, just on paper, I've lost about $544 on that particular trade. So let's go to Qualcomm. I believe they started the week around 116, something like that. 116, 118. And my strike price was 114, but they ended the week at 108.78. So I overpaid by $5.22. Multiply that by 100 shares, and we're looking at about a $522 loss. But I also made $221 on that trade. And so technically and on paper, I lost about $300. So if you think about it, on paper, I lost $1,156 because if I had bought at the prices they were actually at the end of the week, I could have made this. But then again, I made $1,071.61. So technically, I pretty much broke even. on this week. Now, why do I keep saying technically and on paper? Well, let's say next week Qualcomm goes back up to $114 or $115 a share. Then technically I haven't lost any money because now I could resell those shares at the same price that I bought them or more, and maybe even do a covered call and make a premium on them again. Same thing with MetLife. I would hold onto the shares until they go higher than $61 and then probably write a covered call on them and make the premium on those again. So my point in going through this with you is twofold. If you really truly want to have a strategy for covered calls and cash secured puts that is extremely low stress and will have a low probability of executing and being assigned, then just stick to the rules. Don't sell any during earnings weeks or close to the dividend X dates, and stick to deltas that are definitely below 0.20 and maybe even below 0.15 or 0.1. And although you'll be making a few dollars here and there, if you do it enough times and across enough lots, you can make quite a bit of money. So that's the first thing I would say, is that this week I was definitely a little bit more stressed than the previous weeks where I stuck to the rules. But the second thing I would say is that even with all of these things that I set up calls and puts on, all of them were companies that I really actually didn't mind owning. And that's a rule that I definitely want to stick to. I don't want to start reaching really far into kind of junk stocks that I have no interest in actually owning or doing research in. So that's a rule that I think I'm going to keep no matter what. And the last thing I wanted to say is that even if you get assigned and you decide not to roll or close the call or put, it's okay. It may be okay in the long term, as long as you manage that in terms of holding on to the trade until it rises back, and also being mindful of setting up a wheel strategy where you continue to get premiums on those more volatile stocks. Well, that's it for today. Feel free to follow me on Instagram and Twitter if you'd like a more real-time daily update. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.